In today's episode, we are talking dollar cost averaging and building good investment habits. So, we'll talk about what is dollar cost averaging. We'll look at some examples. We'll look at it versus trying to time the market. We'll also look at how I do it in my portfolio and how you should do it in yours. And then just overall, some of the terminology and ways to build those habits. So, if you're liking the content today, please give me a thumbs up. It really helps the channel, helps spread the video. If you could subscribe or share, I'd appreciate it. And let's get started with today's episode. So, dollar cost averaging, what is it? So, some of you might have heard of the term of dollar cost averaging, and it's basically a type of strategy where you don't put all of your money into large purchases in the stock market. So, you average them over time, and you can either decide to do this up front or just periodically invest. And this generally is a conservative strategy, but ends up working out in the long term and beats pretty much every other timing strategy that exists out there. So this article on Investopedia explains what dollar cost averaging is. So we'll talk you through this a little bit. So dollar cost averaging is a strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. So simply what that means is you decide, okay, I have a chunk of money. Let's say I have $1,000. Rather than investing it all at once, you decide to average it out over a period of time. That way, you are buying when stocks are possibly lower, stock prices are possibly lower, or even higher. But overall, you should average out to a better amount than if you just put it in front up front all at once. So the video in this article does a very good job of explaining it. I think you guys should check it out. And we are going to look at another article which explains how dollar cost averaging is almost always the best policy over a long period of time. So in this article on Of Dollars and Data, it's a very catchy title. It says, even God couldn't beat dollar cost averaging. So this author does a simulation basically where you dollar cost average over a period of time. So in this scenario, you invest $100 every month for 40 years. And then in this other scenario, you're trying to buy the dip or timing the market. So a dip is defined as any time when the market is not at an all-time high. And so in this scenario, you actually know when to buy, right? So you become kind of all knowing, right? That's why he uses the term God here. And you know exactly when the market's at its absolute bottom, and then you decide to buy and buy the dip at the lowest possible price. And so the article goes through that buying the dip underperforms dollar cost averaging 70% of the time. And so that's even knowing when to buy, it doesn't work out. And so this article does a really good job. I'm not going to go through all of it, but you can see kind of here are some of the charts that explain this. So the all-time highs here are these green dots on the chart. And then the all-time highs and the dips. So the reds are the dips from those all-time highs, and this is the period when you would buy, right? And this is over a shorter period of time than the overall market. And it shows that even buying the dip doesn't necessarily win, and in most cases it doesn't. So if you are doing it for a very specific period of time, so basically if you're buying the March 2009 dip, then you could outperform the market, but this is in a very short period of time, so it's not necessarily representative of most long-term investor strategy. So you can see that buying the dip actually does outperform dollar cost averaging. However, if you look at a longer time period, right, so from kind of the stock market existence going forward, dollar cost averaging actually works out better. And you can see here, it kind of shows over time what's happening. So again, if you could have timed the Great Depression and bought at the right dip moment, you would have been outperforming. But as soon as you move past the 1930s, basically it doesn't work out, where buying the dip is underperforming dollar cost averaging. There's another good chart towards the bottom, and this chart actually here explains, right, from 1980 to 2010 and going into 2020, you can see that buying the dip, the blue line, actually underperforms dollar cost averaging, and basically the entire time. There's like a little time towards the period at the beginning where it outperforms, but overall it's basically underneath the dollar cost averaging period. And this makes sense because dollar cost averaging is going to still allow you to buy stocks at low periods of time, whereas dips don't always come around frequently. And so you're pushing in large amounts of money, but that money isn't growing at a rate where if you had invested earlier, even at a higher price, that you would see the returns in the future. So the last few bullet points here, or the bolded lines here, are really the highlights of this article. And again, I'll link this in the comments below. But so if you attempt to build up cash and buy at the next bottom, you'll likely be worse off than if you had bought every month. Why? Because while you wait for the next dip, the market is likely to keep rising and leave you behind, right? So you're trying to wait for these dips. However, you could be growing your wealth while the market is rising. The next bullet point is missing the bottom by just 2 months. So not timing it perfectly actually leads to underperformance of dollar cost averaging 97% of the time. So again, dollar cost averaging is the way to go. And then this last bullet is also great. My friends do not realize their beloved dip may never come, right? So you're waiting and waiting and waiting for this dip. And in reality, you might just be missing out on growth, and the market might just be might keep going up and up and up. So I highly recommend you read this entire article. I'll link it down below. But next we're going to move on to my portfolio and show you how I do this with my passive income stream. All right, so let's quickly recap before we go into dollar cost averaging in my portfolio. You can see here that we're almost at the $30,000 mark here. We're at 29,957. I actually was up at 30,000, and that's from mostly market gains. There was some investments obviously here. You can see this peak here. Let's go to the month view so you guys can see these investments. So in the last video, which I'll put a link to in the cards, we talked about how I hit 25,000. I basically invested a significant chunk here, but then I also invested a chunk this past week and got to the 29,926 mark, and then went up to 30,000, and then we came down a little bit in the last few days of the week. But overall, the portfolio is doing well. My returns overall is almost 10%, 9.5%, coming from a mix of market gains and earned dividends. So if we go into my activity for my passive income portfolio, we'll look at deposits, and deposits are what we're actually focused on. So why don't we do deposits and withdrawals? You won't see any withdrawals. I haven't withdrawn any money, but if you guys look very closely, you can see just these periodic investments of $500, right? So what I do, and dollar cost averaging works the more frequently you put in purchases, the better the averaging, right? So what I'm doing is $500 every 2 weeks. I could break that up theoretically to $250 every week. It might lead to slightly better results because it's more frequent. And so the frequency actually makes a difference in your averaging, and obviously the amount makes a difference as well. So you typically in my portfolio, you don't see large amounts going in. This large amount here of the 9,000 that I just talked about, and then another large amount of 3,000. It was not trying to time the market in any way. It's just that I had an excess of capital or cash, and I wanted to put it into my passive income portfolio. So I chose that time, not specifically because I thought anything was super low. And remember that in M1, at least you can set up your allocations and your target allocations so that these buys are actually, whenever you do put in large chunks of money, it's actually buying your underweight stocks, and underweight simply means that it's below your target allocation. So whatever you set up, so maybe the price has dropped over time, and so M1 says, okay, I'm going to buy more heavily into those. So it kind of does some of the buying of the dip automatically, right? But you can see just every 2 weeks I'm putting in $500. This is my example of dollar cost averaging, and I do this automatically. I don't actually have to do anything. This is just set up as a recurring transfer. You can see a few other deposits here. These are ones where I was purposely trying to buy dips, or I just had excess cash sitting around and I wanted to put in some extra money into my account. So the way that I dollar cost average is just through reoccurring transfers. I think this is the easy way. Most platforms like M1 or Robinhood or basically any place you can buy stocks will allow you to set up recurring transfers, and I think that's the best way to do it. So the last topic that we'll cover is building good habits and the best ways to make sure you're investing consistently. So how do you build up good habits, right? Well, so what we know from psychology is that most people, if they have cash sitting around, they will spend it. And so the best way to do it is to never have access to that cash. And the best way that I think is what we already touched on is recurring transfers. So set up an automatic amount. So obviously you need to make sure you're aware of your expenses and that you're going to have enough cash to cover your expenses like rent or a mortgage or your utilities, those kind of things, your food, and, even spending money that you choose to spend. I'm not saying that you should completely eliminate those things in order to invest. But what I'm saying is once you've gone through your income and your expenses, you know exactly how much you have left over. And so you can then split that out over time. So say you get paid every 2 weeks or you get paid once a month or every week, you can figure out, okay, how frequently am I going to invest or set up this transfer? And then you can figure out the amount. And so if you, I'm doing basically $1,000 a month and I have it set to every 2 weeks because that's when I get paid. I could do it differently as well, obviously, but figure that out and then have it automatically deducted or transferred from your account. So that way you don't ever have access to that cash, right? Basically it's in your account and then it's out of your account, and try to set it up so that it's, within days of you getting paid. So that way you really never are tempted to take that money out of your account and use it for something other than investing. And then the second pointer I'll give you guys is just never withdraw from your account if possible, right? So what we saw in my passive income activity is that there weren't any withdrawals. I would say let your money do its thing in your passive income. These stocks, especially with a dividend growth strategy, you want to make sure that that money is building wealth for you and compounding, and your money won't compound if you're constantly taking it out. Now, obviously, if you have an emergency or some kind of situation where you have to take something out of your investment account, that's fine. But you don't want to be taxed for short-term gains, and you also don't want to lose that opportunity cost of letting your stocks compound and getting those dividends going into your account and reinvesting. So those are my 2 tips. Hopefully you guys, if you have any other tips, leave them in the comments below. Hopefully you guys like the video. Thanks again for watching, and I will see you again next week.